I'm Tom Levine, and this is the Native Angelino podcast. Today's episode is a replay and part of the relaunch of the pod, but it's a very timely one. Katie Stockton joined me for a conversation about market signals, momentum, and what the charts were showing. She talks about interest rates, prices, real estate. So if you're waiting for confirmation in any of these markets, this is worth revisiting and investing in. A new episode with Katie, meaning July of 2025, we're going to record and post over the next couple of days. Additionally, I have an archival piece where she talks about the methods behind technical analysis and what she uses and how she does it. So those will all be hosted here on YouTube. They'll also be on 1929.live, my site, and across Apple and all the other platforms. Welcome. I hope you enjoy the episodes. I've got a dozen, close to 24, that we'll repost over time. So thanks very much. Comments, questions, it's all welcome. And I look forward to hearing from you. Enjoy the conversation. Oh, and one last thing. This piece is audio only. Many of the others are with video, as will be the new one. All right. Thanks. Hello and welcome to the Native Angelino podcast in conjunction with the 1929 newsletter. It is the tail end of Memorial Day weekend 2022. The U.S. stock market closed the end of last week at approximately 4160 on the S&P 500, which is approximately a 10% bounce off what we'll learn is an important level at 38.15. Crude oil, West Texas, is at $118 a barrel. Gasoline this past weekend averaged $4.62 per gallon nationwide, and we're well over $6.50 here in California. Inflation and stagflation remain buzzwords and of concern. The war in Ukraine rages on. Coronavirus continues to rear its ugly head, although nothing like what it was 1 year back. We had a week that included another terrible mass shooting at a school in Texas. Housing prices have slipped slightly in some regions, which I suspect is a result of mortgage rates north of 5%. The question is, why is the stock market up? I suspect that this is a bit of a bear market bounce, and we're headed further down. But what do I know? When evaluating the health of the marketplace and seeking to put value on the market overall or individual securities, there are two primary methods for doing this. What we call fundamental analysis and technical analysis. Most people are familiar with fundamental analysis, which looks at things like the particular products a company has and, compares one company's to another, GM's car to Ford's car, and looks at earnings and revenues and balance sheet items. Technical analysis, which may be less familiar to the average person, although of much greater importance as computerization and algorithmic trading has entered the marketplace. Technical analysis uses patterns and price and charts and looks at past trading activity as indicators of the market or the security's future price movement. You can think of it as a pictorial way to try to get a feel and a look at the psychology of trading. Is a student of technical analysis, or perhaps I should say a professor of technical analysis, as she is a veteran of more than 20 years studying the markets. She is known for clear, concise work and has a talent for explaining complex terms or concepts in an easily understandable manner. And Katie Stockton launched her company Fairlead Strategies in 2018 and has recently launched an ETF under the symbol TACK, T-A-C-K, which she'll talk about, which is an ETF based on her strategy and technical analysis. It's a large cap, it's an ETF made up of large cap sector funds. They've just crossed 100 million in assets, and so as I mentioned, she'll talk about that. So without further delay, I will introduce Katie and ask that if you enjoy this podcast, that you share it and obviously comment or ask questions. And again, thank you and enjoy the discussion. It's unique and informative. Hello, it's Thursday, May 26th, and I'm pleased to welcome Katie Stockton of Fairlead Strategies to the program. Katie is a technical analyst, and we'll let her explain what that means, but someone I've known for a very, very long time. And Katie, would you introduce yourself and talk a bit about what you do?
Of course, Tom. Thanks so much, and I appreciate everybody's time. So as mentioned, I am a technical analyst. We actually have a designation, which is a CMT, or Chartered Market Technician. And what we focus on are price trends in the markets. And my market tends to be usually the U.S. equity market. So that's what I tend to talk about most. And that's what I try to understand the most. And of course, there are times at which it's very difficult, like right now. So it's probably a timely conversation to that end. So we're trying to navigate markets by understanding price trends, momentum, and other forces like overbought, oversold readings, relative strength, looking for spots of leadership and weakness. And we're trying to leverage that in an understanding of the psychology behind the marketplace. We really believe that, with all the information out there, it all boils down to a buy or sell decision as it pertains to securities. And those buys and sells obviously reflect supply and demand for all the known information. So it's our job to try to understand not only what the prevailing trends are over different time horizons, but also to try to understand when those trends are turning. And that's how we add value to our clients. We're looking at short-term risk metrics, trying to discern upside objectives, downside objectives, and generally just help them navigate the market.
I understand. And Katie, with regard to the CMT designation, does my memory serve me correct in that you were either the youngest woman to get the designation?
I was the youngest female to receive the designation at the time that I did, which is 2001. So it's pretty amazing that you remember that. I started with the discipline in college, and that was fortunate because it is somewhat of a narrow expertise, particularly for young people. It's not something that's offered in a lot of colleges, certainly more than was the case in the late 90s now, but I went to University of Richmond in Virginia, and we were lucky enough to have some coursework in technical analysis. So I had my CMT level 1 by the time I graduated from college. And I'd also been fortunate enough to have an internship at a firm called Dorsey Wright and Associates, and they provided technical research. And I worked there for about 2 years during college. So I was really set on a path to technical research at a very young age. And then, of course, moved to San Francisco from there. And the rest is history as it pertains to my career, which has, had some variances around that theme of technical analysis, but always applied it on some level. And most recently, that has looked like a technical strategist position on Wall Street in Manhattan. I worked at BTIG most recently, which is a sort of a broker dealer and investment bank headquartered between Manhattan and San Francisco. And I was there for 4 years publishing technical strategy research to institutional investors. And I wanted to start on my own, which we started Fairlead Strategies in 2018, in part because I wanted to reach a broader audience. I noticed that there was a real appetite for technical analysis, not just from the institutional side of the sort of investment market, but also from the retail side. So individuals, and of course, you saw more and more of it in the media. And I just felt that there was a broad audience for it. So now we purvey research to both institutions and individuals. That tends to be sort of U.S. equity centric, but with an eye towards everything macro as well.
How do you get paid for that research?
We have a subscription business, and that's become more commonplace in the market as well, in that we have research reports that we're authoring almost every day. At this point, we're producing content for our subscribers, and that content ranges in its focus, but we have a comprehensive weekly report that covers the U.S. equity market, sector rotation and relative strength, various themes, something like small caps versus large caps, or growth versus value, or what's happening in China from a technical perspective. It also goes over things like gold and crude oil and the dollar and treasury yields to give a complete picture of the technical posture of the market over different time horizons. And that is supplemented by short-term commentary. We do some work on cryptocurrencies. We even do work on cannabis. So we have a lot of variance around that core research product. So we do that. We also provide consulting services, somewhat similar to what we actually did when we were on Wall Street, but under this different subscription model. And we've actually found that the folks that subscribe to our consulting are largely individuals or family offices. And that was somewhat surprising to us. We didn't really expect that. But there's a lot of, family offices and individuals who are highly interested and involved in the markets, and, many of whom were disenchanted at one point with their financial advisors and, wanted to be a bit more of an active participant. So that's been a great sort of area of growth for us.
And over the last 20 years, let's say, since your 2001 designation, what are the major changes you've seen in the markets?
Well, a lot. So where do I start, right? 20 years. So as it pertains to technical analysis, which is really my narrow area of expertise here, it's changed a lot, and not in the methodologies and the indicators and the tools that we use. That's actually really remained the same. Just people have gotten creative in different ways to look at it, and obviously leveraging the technology and software that we can now just cover so much more ground with. So the advent of the software programs that we're using, I mean, boy, it looks nothing like what it looked like in 2001. So our capacity has certainly increased due to technology. We can be spread more thinly in terms of what we're looking at. Think about a market scan. Well, it goes a lot faster these days, of course, than it did 20 years ago. So that's been great. But really, the methodology for us has developed over the years, and we're using indicators that in some cases were developed literally in the 1800s. Such as the Ichimoku cloud model. And that's a Japanese model that was developed by rice traders. And that's the one that goes the farthest back. But it was their way of recording price trends. And it holds a lot of value in our work. So it's all very mathematical what we do. And obviously these things were established, well before we had, the computers to crunch the numbers. So there's some that are very simple. And some that are more complex, but together we feel like we get a good, more objective view of the markets and trends by using these mathematical indicators. But in terms of the market structure or composure, Obviously, the participants have changed. I found that most recently they've gotten much younger, and certainly, much. Well, maybe that's always the case as I get older, right? But also with the advent of the cryptocurrency market, that's, I think, really instilled this new interest in markets in general among younger investors, and also the access to information that they have is just so much more robust than what we had when we were young. So it's really brought in this sort of new flux of young, hungry, interested investors. And I actually don't mind for that reason that we're going through this down cycle in the markets, broadly speaking, because it's good to get one of those out of the way early in your careers. So for the young people to see a down cycle, that's going to help them in their investing longer term, because they'll realize that things, don't go up all the time, and there are risks, and here's how bad it can get, and here's how to navigate through that. So certainly, in terms of the investing public, that composure feels like it's changed to me. And then in terms of the market itself, I've never been one to focus much on volumes. In the very early stages of my career, I did. But I found that the volume data started to lose its value, to me at least, in that you would read a textbook and it would say, well, if you see a price trend, you want to see volume growing as that price trend persists. And when it stops growing, well, that's an indication that the trend might be tiring. Well, that just stopped working. And I think what had happened that took away from the value of volume data was the advent of alternative products like exchange traded funds, for one. Those, obviously skew the volume in various stocks at least. And, derivatives products, of course, have been a big change in terms of market offerings and certainly have impacted volumes. And then we have algorithmic trading, which has contributed to, sort of gamesmanship, I would say, around different levels on the charts that we're using. One of our very common metrics that technicians tend to focus on is the 200-day moving average. And the 200-day moving average, you'll sometimes see a flurry of volume come in around that level. And that's probably not because a lot of people are sitting there watching it, but there's a lot of programs that have the 200-day moving average as an input. And these programs put in automatic trades, to foster their strategy. So it's been really interesting to see all of that. If anything, it's created, I call it time compression. That's just my term. I don't know if that means anything else than how I'm using it. But what it means to me is that what used to take weeks now takes days. What used to take months now takes weeks. So it just feels like we've gotten this sort of compression, and with that we have more challenges, and we're a little bit. I guess we're forced to become more short term in our orientation.
Very interesting, and to put it in perspective and perhaps make you feel young, my first down cycle after a year in the marketplace was 1987. So I hope that helps a little bit.
But you'll never forget it, right?
You're absolutely correct. Having that early in my career was a very, very good bit of training that you can't get any other way.
Mm-hmm. That's right. And you're probably losing a lot less when you're that young than when you're fully invested later Absolutely. In life, right?
And then, the big change, I've seen, obviously technology, but what I call is that you alluded to, the Googleization of information, whereby it's free, it's cheap, it's easily accessible, and things just move much, much more quickly. So the time compression comment makes a lot of sense to me. So we'll talk about your newly released ETF, the symbol TACK, shortly. But before we get specifically to it, do you use a macro overlay or the kinds of things that I'm thinking about are, when you've got big changes with, liquidity being removed from the system in a large way or something like this, or a down cycle where we know that rising interest rates has a negative impact on stock prices and PE compression has a negative impact. Do you use these overlays in any way, or does it just come out in the numbers for you?
We are not macro in our orientation, except to the extent that we read a lot of macro research. I have a lot of friends. I say I roll in sort of macro circles because I have a lot of friends who that is their primary discipline. And I value their opinion. So I read a lot of their research. And I find that it's all obviously very informational. And it's one of those things that answers why something is happening. And it also tends to be very long-term in focus. So it's not perfectly aligned with what we're doing in that rather than trying to understand why something's happening, we just simply want to know what's happening. We just want to know how all of that information is impacting price. That's our area of focus. But we do find it interesting. And we certainly know that a recession is on the radar, and that might sort of set a different tone in our mind. But we're going to, before letting that subjective sort of view influence how we're feeling about the markets, we're going to adhere to our indicators first. So we're always going to give more weight to the technical indicators than any of the news that we hear or any of the data that to us is longer term in nature. So we tend to be a little bit more short term in our orientation because that's where we feel we can add the most value. Whereas the long term trends, as you can imagine, really are driven by exactly that. They're driven by liquidity and the Fed and macro forces, not to mention fundamental research, as fostering. These are these long-term earnings trends. These are the most important drivers of stocks. And yet we don't focus on that because we're trying to create an unbiased look at the chart itself, which of course reflects all the supply and demand for not necessarily the company. You want to think of it more as a security representing the company. And that brings up something important in that the security, unfortunately, doesn't always stay in lockstep with the company's fundamentals. So we call it navigating the gap between that sort of fundamental trend and the actual trend in terms of the stock price, because there can be major times of dispersion and disruption in those relationships. And oftentimes when you see a stock acting poorly, despite very strong fundamentals for the company, it's wholly related to the market, right? So we tend to see correlations go very high on the individual stock level when the markets are going down, for one. So investors are just penalizing every stock. They're not as focused at that time on fundamentals. So we can help navigate those types of environments. Especially.
So in those environments known as throwing the baby out with the bathwater.
That's right. Sometimes it feels like you can't find anything that looks good from a technical perspective, but thank goodness the market's global and there's alternative asset classes.
With that in mind, I've seen you on a couple of programs over the last couple of days, and the lower band of the S&P, I believe you suggested perhaps 3,200, which is down 20%.
Yeah. So to me that seems.
I wouldn't disagree. I'm just interested to know technically how you've come up with that number.
Yeah. So we look at things called support and resistance levels. Think of support as a potential area of buying pressure or demand, and resistance as a potential area of selling pressure or demand. There's a lot of different ways to discern these levels. One would be something like the 200-day moving average, as mentioned. You do find that sometimes those moving averages, maybe in part because they're so widely followed, become important support or resistance depending on the prevailing trend. And also we use things like Fibonacci retracement levels. So getting really mathematical here to try to understand where a natural retracement would be of a prevailing trend. And Fibonacci, the sequence is really fascinating for those who have spent some time on it. It's not just found in markets, it's found in nature. And we really rely upon those Fibonacci's as well. So that 3,200 level is based on a Fibonacci retracement. It happens to be a 61.8% retracement of the S&P 500's uptrend off of the pandemic low in March 2020. And it's just often a place where we find buyers step in. Now, we don't have that as an official downside target. We're not really trying to be ultra predictive in our research. In fact, we're really just trying to keep people on the right side of prevailing trends and give them an understanding of what risk might be if something breaks down. So we always have defined risk metrics. And before that 3,200 level becomes relevant, we have some interim support, first residing around 3,815 based on another Fibonacci retracement level. And that's serving as the staging ground for an oversold bounce here, which is, again, very natural. We suspect that level will be broken just given the loss of long-term upside momentum that we've identified really as of late last year. And we think we'll kind of stay with the market for another few months, potentially based on what we're seeing. So we are trying to manage risk. We're trying to capture some of these relief rallies just as a way to use as a selling opportunity or put on some market hedges for those that have to remain exposed. So we're trying to navigate the short-term swings, but within what we consider to be a bear market cycle, within a secular bull trend.
So let's just describe that, a secular bear cycle. What are you describing here?
So cyclical bear, secular bull.
Mm-hmm. What you're saying is the long-term trend remains solid upwards, but a downtrend is what we're facing now.
Right. So almost think of it intermediate versus long term. So in a downtrend right now, we've even seen heavyweights like Apple break down. So we're being respectful of that as something that should keep the market in a downtrend for potentially a few more months based on what we're seeing and just really based on historical averages using the technical indicators that we adhere to. So that's how we get a sense of time horizon. But we're also really never married to a view. I mean, the market's dynamic, and if it changes, we try to respond to that pretty quickly. And so I think you'll probably know that technicians are not as committed to their views. I think if something changes, we're pretty quick to change with it. And that happened. I think technical analysis, in fact, really got a good name in 2008 when so many technicians were vocal about the bearish reversal. And a lot of other folks just wrote it down. So I think that was a very good period in a way for technical analysis and helped it gain some credibility among the skeptics out there.
In the relatively short run, what would it take to break the long-term uptrend?
For me, it is that 3,200 level. So I'm glad you brought that up because below a 61.8% Fibonacci retracement, you tend to see a full retracement of the uptrend that you're using to gauge that level. And as you know, that would take us back to the March 2020 low for the S&P 500. And unfortunately, that would mean that we're getting into a support or going through below a support level that defines the secular bull trend. So we really want to see that 3,200 level hold if we were to see the market get to it, because it is kind of a key breaking point of that secular bull trend, in our opinion. So certainly important to focus on the levels. And then also, of course, the indicators that we use, which are really better on the monthly bar charts that we're using. Those indicators would probably have implications of no more than 9 to 12 months. If we were to get ultra long term, we'd have to use a different, like a quarterly chart or something like that, which we don't tend to spend any time on in our work. But as it stands, we're making the assumption that this is just a bear market cycle.
What was the March 2020 low?
March 2020 low was, I'll give you the number. It looks like it was about 2192.
So that's a ways down.
So naturally, I know it feels like ancient history, doesn't it?
All right. So with your permission, I'd like to spend the rest of our time talking about Fairlead Strategies and the ETF you've launched. Maybe we can just start from the top and I'll listen and you tell us all about it.
Yeah, by all means. And this is a new product for us. In fact, it's our first investable product and it launched in March. It's called the Fairlead Tactical Sector ETF. And as mentioned, the symbol is TACK or TACK. It's listed on the NYSE. And it's an exchange traded fund that's designed to leverage sector momentum and relative strength. So we really believe that the way to outperform the broader market is by being in the right sectors, to be following the momentum there and making sure that you have concentrated exposure in those sectors. If you look at the sector returns year over year, you'll really see a huge spread. I mean, this year is a little unusual in that we have energy is posting something close to 50% returns year to date, and then the next runner up is in negative territory. So
are we talking S&P sectors here?
S&P sectors, yes. So it is a U.S. large cap equity focused fund, but it has this risk off piece to it. And it's a major differentiating factor of the fund in that it has the ability to manage risk by moving into risk off categories, including gold, short-term treasuries, and long-term treasuries. We're doing this all via the SPDR ETFs or State Street ETFs, which are very liquid, very low in their expense ratios. And so we're considering the 11 sector ETFs, sector SPDR funds, for inclusion in the strategy. And we're using our technical methodology, which we've isolated into a set of rules. It's somewhat complicated, but the goal is simple in that we're really trying to leverage the momentum. And by applying our technical analysis to these sector SPDR ETFs, we come up with any number that will meet our requirements. And if there's 11 of them, well, we're going to take the top 8, and that will be our portfolio. If there's only 8, we'll just take 8, and that's our portfolio. However, when we start to lose that participation, meaning some of these sector ETFs are not trending higher, they don't have the momentum that we're requiring. If say 6 of them are hitting our filters, but that's all we have. Well, then the remaining buckets, so those remaining 2 buckets will be divided equally between those the gold, short-term treasuries, and long-term treasuries. And we find that over time, that kind of slow risk-off movement is really incremental, year over year to performance, in that it minimizes drawdowns over history. And that, of course, is at the end of the day what a lot of us are trying to do. We want to have the U.S. equity exposure, but we want to feel comfortable, like we won't, be dragged down in this type of environment in particular. So when the fund was launched at the end of March, of course, it was a very difficult environment for the equity market. So it's sort of proven its muster in terms of reducing the drawdowns associated with I think it was about a 15% drawdown already since we've seen for the S&P 500 since the inception of TACK. And TACK was down at its lowest point about 7%. And is really participating on the upside too. So it's doing what we would hope it would do in this kind of environment. And it's essentially, just shy of where it was actually launched. So it's really held on to its sort of trend here, which is exactly.
So in fact, you're essentially flat right now, with the market being down substantially more.
Essentially flat. That's right. That's what I mean. Yeah, and to be flat in this market is very welcome.
Absolutely.
I think so many folks have ridden the market lower and watched positions that they felt were safe, like in Apple, really go against them. And this creates some downside protection by moving into those risk-off categories, and also, at times tilting more defensive in the sector exposure. Right now, for example, the fund is about half sort of divided on those risk-off categories. And then the other half is mostly defensive sector exposure, like utilities and consumer staples. But then it also has an energy component to it, because energy is working. Energy is, may not lean defensive, but it's a sector that has maintained positive momentum and relative strength. So it's been right to have that exposure, and it's been beneficial to have that exposure at a higher percentage than the S&P 500 does itself. So that's really the dynamic and active component that can, enhance performance.
So if you have, for example, 8 elements to your risk-on position, are those 8 elements equally dollar weighted, or do you weight them according to the strength of the uptrend, shall we say?
They are equal buckets. And we found that what that ends up doing, it actually rewards some of the smaller sectors in the S&P 500. So especially like what I just said about the energy sector is a very small piece of the S&P 500 in its cap weighting. So we found that over time, having that equal weight exposure to the winning sectors was really beneficial. There are times at which maybe sector positioning or sector momentum and relative strength will be highly concentrated in a sector that has a big footprint like technology. And that's where you would expect TACK to lag a little bit in terms of versus the S&P 500, because it will have a smaller footprint in technology than the S&P 500 itself would be exposed to. So that's what we would expect. But I think what we found over time is that the participation was such that, we were still involved and then also had that kind of risk off piece to it in our models that helped prevent really riding the market lower when it did reverse.
Are there 11 total inputs or 14?
So 14, a good point, 11 sector inputs and then 3 risk off inputs.
You could theoretically be 100% exposed to the market.
Yes. Yeah. So it can go from 100% to zero. A zero or fully risk off portfolio would be 1/3 gold or GLD as an ETF representing gold, 1/3 short-term treasuries, and 1/3 long-term treasuries. And that in our models doesn't happen often, as you'd imagine. It's really very rare that it would go to that complete risk off position, but it has happened, and you can probably guess which markets it would happen in, and that's really been a great sort of protecting factor based on our models.
So just so I understand the math, let's say you had 8 risk on positions. Does that mean you're 56% long or 56% exposed?
So for the 8 long positions, we're actually just 8 buckets are going to be each about 12.5%. So that will be 8 buckets totaling 100% exposure.
Okay. And then how would you then slide to risk off exposure from that? So you're looking at... Mm-hmm.
It's somewhat unique in that if one of those buckets isn't being filled by one of the sector ETFs, then we take that bucket and divide it 1/3, 1/3, 1/3 into the risk off categories. And it's that diversification of the risk off piece that we find a lot of value in. If you notice this year, especially, I mean, look at what treasuries did in Q1 of this year. It was not what people would have expected. So they traded very sharply lower alongside the equity market. So they weren't providing the safety that folks would attribute them to. So I think that kind of lack of the normal correlations over history, by diversifying that exposure, you minimize the risk that you carry with any singular asset class. We found that a lot of asset allocation models and funds tend to move wholly into long-term treasuries as their component. But we find that diversifying that into things like gold are really helpful and they take away some of that concentration risk.
And you've had a pretty decent ramp in the first month or so. You're at about 100 million in assets now?
Yeah, we just hit about 100 million yesterday, so it's been really well received, and I think it's in part because the market, the market that we launched in allowed it to sort of prove itself and what it's very good at doing in terms of relative performance. If you look at the trend relative to the S&P 500 for TACK, it is a pretty solid intermediate term uptrend. And that, of course, has been appealing to folks in this environment. We find that, people are sort of throwing up their hands and say, well, what do we do here? Because we're not accustomed to this. And, we have a lot of folks that worry that they won't get back into the market quickly enough if they go down to very low exposure to U.S. equities. So they largely want to keep some exposure to U.S. equities because they know that coming out of these types of environments, one, sentiment is usually so affected that it's really hard to get back into the mentality of buying and building exposure. So that the benefit of TACK is that it does it for you. So it knows from a momentum perspective when risk off is appropriate, but it also will dynamically rotate back into these risk on sectors when it's appropriate. And that's based on the long-term indicators. So it will eliminate some of the noise found around V bottoms and things like that, but it will capture, longer-term trends and shifts.
And for those interested in reviewing and purchasing the ETF, it can be done through all the major platforms?
Yeah, I think all of them. On some level, there's a couple that we're still not onboarded with, but most of the platforms, and Schwab, for example, and you can call your advisor, and they can usually get access to it. So it is pretty accessible at this point. I can't say it's all, but we're getting close.
All right. So one final. Is there anything that I should have asked you about that I haven't, or anything you'd like to add in closing?
Oh gosh, Tom. I mean, there is so much. I think if anything, it's cryptocurrencies, because what I found is, I think about what I get the most questions about these days. And the questions about the cryptocurrency market are coming from folks that are not even remotely close to investing in it because it's on their radar. And what I will say about that is that technical analysis to me is one of the best ways to approach cryptocurrency investing or trading, because it is a very sort of pure supply demand driven market. It's, these trends are adherent to all of the technical indicators that we use. So especially because I sense that, some of us don't have the best understanding of what we're investing in at times here. It's great to have these technical tools and trends on your side in a market that's largely or misunderstood or not, fully mature in some ways. So we really have found a lot of value in applying our indicators to cryptocurrencies, and it seems to be getting
And crypto is included in your general subscription?
We have a separate subscription for that. It's just a weekly report that we're putting out, and we'll be speaking at a conference soon. The CoinDesk Consensus Conference is coming up. So, we've been learning a lot ourselves about it. And of course, we have our unique approach, but it's really fascinating to us. And, we're in, of course, a down cycle in the likes of Bitcoin as well here. And we've seen with that down cycle, cryptocurrencies really take on the character of a risk asset as opposed to the sort of gold alternative that some might have hoped it would be earlier on. And maybe someday it does prove to be that. But for now, the correlations are pretty high with the equity market. So it's been interesting.
And then finally, for someone interested in the subscription, is it just a matter of going to your site,